Hello, and welcome back to the COVID-19 Comeback Series. I'm John Mitchell, and I'm a corporate partner here at Williams Mullen. This is another video in our series intended for commercial borrowers to help them navigate their relationships with lenders in a down economy. As in our first video, we'll hear from two of our top lender lawyers who will share their unique insight into how banks think. They are Matt Cheek, who chairs the firm's Financial Services Industry Group; Mike Mueller, chair of our Restructuring and Bankruptcy practice. In our first video, Matt and Mike introduced the idea of working with your lender proactively in tough times, and they explored some of the psychology that borrowers often experience and gave tips to make discussions more successful for both sides. Now, we begin digging a little deeper into the mechanics of that process. In the remaining three programs, we will first cover an introduction to loan defaults, then how banks respond to defaults, and finally, the path to forbearance, aka the proverbial light at the end of the tunnel. Our goal as counsel to banks is to demystify how banks think about defaults and help borrowers have constructive dealings with their lenders in the months and years ahead. So let's get to it. Mike, I'm going to start with you. Why exactly are we talking defaults and workouts at this juncture? Why is this topic so much on the minds of lenders right now?
Well, that's a good question, John, and thank you. And hello, everyone. We're talking about this because, candidly speaking, while everyone's hoping for a quick recovery in the economy, and despite the rhetoric, frankly, lenders are expecting a tsunami of loan defaults this fall. We've got a couple of things that are in play that are holding off that tsunami for the time being. You've got the PPP loan funds that a lot of businesses have been able to take advantage of, but those funds are going to be running out. We also have the interagency guidelines that permitted banks to defer payments or defer interest payments for borrowers up to 180 days without it being declared what's called a troubled debt restructuring. But that's also going to expire at the end of this fall and at the end of the third quarter, beginning in the fourth quarter. Matt, talk about the quarterly financial reporting that is going to come up as well this fall.
Sure. So in addition to the points you've made, Mike, many companies operate on either annual or quarterly performance measurements. And to the extent that a company is sharing quarterly financials with banks or is subject to financial performance covenants, if you think about it from a timing standpoint, the June 30 quarter end financials, usually they're due, say, 45 days after quarter end. So that would be in the sort of the now range. And I think many banks probably at the moment are willing to see covenant violations as something that they might be willing to waive or modify. We'll talk about that in a minute. But when you get into the September 30 quarter end financials, which would be due, November 15th or so, the bank's ability to waive and modify might be more diminished. So here again, you're seeing at least in November, and then when the next quarter results come out for 12/31, you can see this happening with all of those annual reports. So sometime in the fall, we expect to see a second round of a whole lot of covenant violations. And then on top of that, in addition to the PPP money and the interagency guidance that you mentioned, Mike, you've got an election, and markets hate uncertainty. And as you said, this is not really intended to be an economic outlook, this discussion, but I think we all certainly hope that there's a Nike swoosh or a V or a checkmark economic recovery. But I think some of the realities we just mentioned are very real. So.
Okay, well, Mike, let's turn back to you. Banks are understandably keeping a careful lookout for defaults. That's obviously a bit more complicated than just late payments on loans. Can you break down this concept for our viewers?
Sure, John. As you mentioned, events of default is broader than just monetary defaults, which is typically failure to make principal or interest payments as and when those payments are due. But defaults are much broader. If you look at your loan documents, and by that I mean your deeds of trust, your security agreements, your promissory notes, your loan agreement, guarantee agreements. They all typically carry or contain events of default. And as you mentioned, there's monetary defaults, but there's also non-monetary defaults, and it can be a breach or violation of any covenants, warranties, or representations in the loan documents. And so let's talk about some specific other types of defaults besides monetary defaults. You've got covenant breaches. You have affirmative covenants such as requirements to furnish financial statements on a timely basis, maintain insurance, compliance with applicable laws, maintaining books and records. Failure to do any of those affirmative covenants can be an event of default. You also have negative covenants or financial covenants. Those are generally financial ratios such as loan to value ratio, debt service coverage ratio, debt to equity ratio, interest coverage ratio, maintaining a minimum EBITDA, that sort of thing. You have representations or warranties in your loan documents, and if they're no longer true or misleading, that can be an event of default. You've got insolvency types of events of default: appointment of a receiver or a trustee, assignment for the benefit of creditors, voluntary or involuntary bankruptcy, forfeiture or foreclosure proceedings being commenced by another creditor or lender can be an event of default. The borrower is granting liens or encumbrances or transferring property can be an event of default. Where that comes up is if a borrower is struggling financially and wants to obtain additional credit and goes out and tries to obtain a loan from another lender and it grants a lien or encumbers property in connection with that, that can be an event of default under your existing loan documents with your incumbent lender. You also have general insecurity clauses, material adverse change clauses, such as where the bank has a good faith belief that the borrower's prospects of payment or performance under the loan documents is impaired in any respect. That can be an event of default. Situations where the borrowers are unable to pay their debts as they become due in the ordinary course of business can be an event of default. And another important concept I want to raise here is what are called cross default provisions. A default where you have a cross default provision, a default under a guarantee or a default under the loan agreement can be a default under the promissory note or under the deed of trust and so forth. So as borrowers, you need to be very familiar with your loan documents when you're heading into what we call the zone of insolvency, or if you think you're going to have problems repaying your loan or performing under your loan documents. If you're not familiar with them, you don't know what performance requirements you have other than typically payment requirements. So you want to be familiar with your loan documents so that you can do what Matt and I talked about last time in our last session, which is run to the problem and give your banker or your lender a heads up that you might have a default. So what happens if the bank decides that there's been an event of default? Typically, upon an event of default, the bank will provide notice to its borrower of the default. That will typically be a formal notice so that the bank can document its file. They'll send a notice of default, not only to the borrower, but as Matt touched on last time, the guarantors will also get notice. Banks do that for specific legal reasons, but the point is that letter or notice of default will come not only to the borrower or the obligors, but to the guarantors. So you want to be prepared for that. Typically, loan documents will have a cure period. And if there is a cure period, the borrower has the ability to try and cure that default before the bank exercises remedies or takes other more aggressive steps. So when you get that notice of default, again, as we talked about last time, you want to try and address it and be proactive about the problem, hopefully within that cure period, and cure the default. If you fail to cure the default within that cure period, or you're not communicating with the bank is going to declare the loan in default, and it can do one of two things in that instance. It can reserve its rights and say, basically, we're going to stand back for the time being and see how this plays out. Or the bank can accelerate the debt and make a formal demand for payment. Well, when the bank does that, that's an invitation for the borrower to come back to the bank and try and communicate with the bank and hopefully get the bank to enter into a formal workout or loan restructuring, get the bank to agree to forbear from exercising its remedies. Typically, the bank will do that in exchange for certain agreements by the borrower as set forth in the forbearance agreement. The lender is typically looking for additional security. It wants to improve its collateral position. Other concessions from the borrower, it might place tighter restrictions on the borrower's operations, the borrower's expenses and freedom to pay expenses. They may limit distributions to insiders and so forth. That would be preferable from the borrower's perspective, is that the bank enter into some sort of forbearance or workout. But there are instances where the bank may decide it wants to formally pursue its collection remedies against the borrowers and guarantors. That can happen in different situations. One is where the borrower's business is just obsolete or there's no cash flow. The bank may decide that there's no ability to rehabilitate this debt or no reason to enter into a forbearance agreement or a loan restructuring. The writing's on the wall that the borrower is not going to be able to perform. And if that happens, as I mentioned, the bank will decide to formally pursue its collection remedies. Well, what does that look like? If the bank has collateral pursuant to a security agreement or a deed of trust, it can liquidate its real property. You can see that in a foreclosure proceeding, or maybe the bank will agree to take a deed in lieu of foreclosure. With respect to personal properties such as equipment, that type of thing, the bank can exercise its Article 9 remedies and do what's called an Article 9 sale, which is a foreclosure under Article 9, to liquidate its personal property collateral in the form of a private or public sale. It can exercise its remedies against cash collateral. It can collect its cash collateral, which, the bank's receivables or the borrower's receivables, that is the bank's cash collateral. The bank can collect those and not give the borrower access to those, to that cash collateral. It can also pursue a judgment against the borrower and guarantors. And what that looks like is a lawsuit, a breach of contract suit against the borrower or guarantors. In Virginia, loan documents frequently will have what's called confession of judgment provisions, which bypasses the trial stage, and the bank can just go to the clerk's office pursuant to the loan documents and confess judgment. Once the bank has a judgment, either after trial or through confession of judgment, the bank has remedies that it can exercise. It can record judgment liens in counties or cities where the borrower or guarantors have real property, so that it can obtain a judgment lien against that real property. With respect to cash accounts, banks can issue garnishments after they obtain a judgment. These are post-judgment remedies. They can issue a garnishment to seize funds held in bank accounts, not just the borrower, but including the guarantors once a judgment is obtained against a guarantor. It can issue writs of FIFE, which permits a sheriff to go out to the borrower's or guarantor's location and levy on personal property. But the important point that I want to bring back to our earlier session is that what the lender decides to do, whether it decides to pursue collection remedies or enter into some sort of workout arrangement with the borrower, is going to depend a lot on the issues we discussed in our last session, which is mainly the character of the borrower. Is the borrower trustworthy? Is the borrower being communicative? Is the borrower running to the problem and actively working with the lender to solve or address a problem? If you as a borrower are actively working with the lender and being proactive, your chances that the lender is going to work with you and try and work through these liquidity issues with you are a lot greater versus if you're not running to the problem, if you're being difficult, if you're being uncooperative, you may be communicating to the lender that it has no option but to pursue its remedies and liquidate its collateral and pursue collection remedies.
Well, thanks for that, Mike. Yeah, so Matt, again to you. Mike has laid out a range of actions that may happen from the bank side when there are defaults. And I'm wondering if you could give us a little bit of a peek behind the curtain at what is the bank thinking about really as a part of its business when it is considering how to respond to different kinds of default.
Sure. I like how you said, John, that Mike's description was a range. And for the viewers, I'd like to focus on that analogy and think of this like a spectrum or a ladder, gradations, if you will, from green to yellow to red, or DEFCON levels, or whatever your analogy would be. And so what Mike has laid out is this ladder, if you will, these stair steps of intensity. And from the formal default standpoint, it could be a breach or violation of covenants that get waived or modified. It could escalate to a formal declaration of default. That could escalate to a formal demand and acceleration. That could mature into a forbearance agreement, workout, as Mike said, or if all else fails, then it turns into a liquidation, enforcement, of remedies. And that's the sort of stair step. And I think part of what we wanted to impart today was that vocabulary of those gradations. And running alongside that ladder is the whole character issue that we've discussed, just like Mike said. I couldn't agree with that more. Running alongside all of that, you have the risk assessment that's going on inside the bank, John, and that's what you were asking about. And so I guess what I would say is every once in a while you get a borrower who says, well, I'm in default, or these things are happening, and you know that my business is in trouble and times are bad and all this stuff. And the borrower sometimes will say, well, bank, you have all the cards, you can do anything you want here. Can't you help me out? Why can't you help me out? Why can't you do this? Why can't you waive? Why can't you just let this go? And the answer is that there are lanes that the bank has to run within. And some of those lanes are driven by internal policy. Some of those lanes are driven by their regulatory environment. It's easy to forget that these banks are regulatorily governed in a pretty heavily scrutinized regulatory environment. And so what that means inside the bank, to answer your question about peeling the curtain back, is that banks assign risk grades to each one of their credits. And in very simple terms, the traditional risk grading runs from 1 through 9. And in very, very basic terms, loans that have risk grades that are 1 through 5 are known as sort of not adversely classified. They have different titles for this. I'm not going to get into all of that now, but they include titles like pass, or if it comes up to a 5 level, it might be a special mention. But those are generally not adversely classified. Grades 6 through 9 are adversely classified regulatorily, and the vocabulary for this would be that the loans are substandard, doubtful, or loss level. And so that's kind of the ladder that's happening inside the bank too. And so what happens when you click up these different risk grades are two things. One is that banks have policies that they have committed to their regulators that they're going to follow, that if there's a certain risk grade that's been triggered, the banks have internal policies that they're supposed to be following as examined and administered by the regulators, that when it hits this certain level, this is how they're going to behave. And so just realize that banks have these rules in place. And secondly, regulators do examinations. And when times are tough and when we have recessions, regulatory oversight goes up. And there are examiners who will much more heavily scrutinize the higher risk grade credits. So just realize that there's a playbook in place that banks are supposed to be following. And the other final thing I'll say too is that as risk grades go up, banks also have regulatory requirements around their own capital reserves. So if you are a pass grade, banks might not need to allocate additional capital reserves to buttress that loss. But if you're at a loss level or above a 6, banks' capital requirements, which again are regulatorily administered, are going to be greater. So there's a cost to the troubled loans. And sometimes borrowers don't remember the fact that we're not just talking about a potential loss to a bank in terms of lost principal or interest, but sometimes we're also talking about tying up the bank's capital, which is frankly making the whole situation much more expensive for the borrowers. So that's behind the curtain, John. That's the ladder that runs alongside these other ladders.
Well, thanks, Matt. And also, Mike, you guys have really showed us a lot of what borrowers can usefully know about how banks are operating and how they're dealing with borrowers who may run into some trouble and have defaults. So that's a wrap on today's show. We thank you for tuning in, and certainly hope that you'll join us for the additional episodes we have planned. Look for them coming up. For questions about today's topic, please contact any of the panelists. Our contact information is at the end of the video. Also, please be sure to visit williamsmullen.com. We are constantly posting new resources to help your business make your COVID comeback. Thank you again, and be well, everybody.